first rates down, down, down. That's the Nifty, Sensex and the Bank Nifty, but down by what, 40 points on the Nifty, 123 points down on the Bank Nifty, and small cap index is down by about, it's actually flat. To be fair, it's actually flat. Let me start picking up stocks which are purely based on patterns. I think Sona BLW deal is also done. I can see it on my screen. So 2 block deals right at the start. Okay, now what else is picking up? Jyoti Structures, 9 rupee stock, 6% higher. You've got price action which is there. It's very random, honestly. Let me just see if I can pick up something very constructive apart from just random price action. Mazgaon Dock Shipyard, that is opening up very smartly. Suzlon is opening up very smartly. The volumes are just not very consistent with what is happening in the market. I think it will take some more time before we get a very decisive kind of a move, because there is nothing which can be called as a very powerful mover, and there are hardly any newsmakers right now. But the screen, I think, is only indicating that the volume action in mid and small cap stocks is still very strong.
Like it's the metal space which is starting with the maximum amount of downtick. Of course, that Chinese PMI data is expected to have a bit of an overhang on that space. So Hindalco, Jindal Steel, Nalco, NMDC, these are the counters which are down, and of course the fact that coal prices have also increased, for some of the users it might be a bit of a negative news. PSU banking space continues to see a lot of profit booking, so SBI actually has opened with a cut of almost 2%. You also have Bank of India, which is down in the trading session. The only space which is standing out tall is the realty space. Look at Lodha today as well. That stock is high around 3.5%. There was an adjustment that was expected on account of bonus, so maybe that's also having an impact, but nonetheless that stock is quite excited, 3% higher. Torrent Pharma is sitting at all-time high levels today, 5% higher, and that's the result reaction coming for you on Torrent Pharma. A good set coming in and the street rewarding that. Now the gains are increasing, a 7% gain as far as Torrent Pharma is concerned. HDFC Life, as we talked about, that entire supply is getting absorbed by HDFC, which is again a long-term investor coming in, so no more overhang of supply. And then there is names like Science, Seat Limited, Welspun Corp, which is also in the spotlight. On the losing side, Adani Transmission and Adani Gas are 2 names which are seeing an impact on account of that MSCI outflows. And then Coal India surprisingly is actually down in the trading session. The street was betting big on the price hike that the company has taken, but seems like that the market is not giving it a big thumbs up. For now, Coal India has started on the back foot.
Okay, yes indeed. Just taking a look at the broader markets, a mild flicker of green, but nothing to really shout home about, given the fact that as of now, it's a pretty flattish trend across the board. Names within the broader markets as well that are managing to eke out a gain this morning on the Nifty 500. Well, that includes the likes of Torrent Pharma, Cyient, Indocount, Spandana, Seat, Lemon Tree Hotels, a result candidate, and Sun TV. Naresh, let's get a view from you. Looking at the screen right now, you said one needs to be a little bit patient for those all-time highs, but what's the first trade that you're punching in?
Buying into AB Capital, that looks interesting. Said 170 risk reward trade, would keep a stop loss at 160 if I expect a move towards 180, 85 in the short term.
Well, that's the stock that Naresh is looking at. I know, Shivangi, you're pretty bullish on this one as well. Is that your first trade too?
Yes, I'm pretty bullish on that. But for the first trade, I would like to choose HAL. This stock has, seen short covering move in this series so far in the last 1 week, and this looks quite positive, for the upside. A little declines would be, a good opportunity to add in today. Good breakout and follow-up buying as well. So 3250 would be a level to watch out for here, and with a stop near 3060 levels.
All right, Resh, Shivangi, appreciate your time. Thank you for joining us. Dixon is looking strong. You've got this entire manufacturing wheel which is now humming very, very strongly. I mean, markets are not trying to say, okay, is this the defense? Is this the defense space of 2021 and the railway stocks of 2023? By the way, where are the railway stocks? RVNL, IRCTC. You had the whole bouquet, so to speak, and look at that. IRCTC, well, it's a different, it is a play on travel and tourism, but RVNL, 111 rupees. You got the entire gambit, so to speak. If I may just add some more railway stocks here. Tesmaco, indirect play on railways. Titagar, indirect play on railways. This entire space now seems to be puffy duffy. What has happened is that railways took over from defense, and manufacturing has taken over from railways. But there's always this wonderful sectoral rotation which is now happening. Wherever the size of the opportunity is very large, like defense, India is going to be importing less defense equipment from global defense suppliers. You want to make it Atmanirbhar. Boom, all the defense stocks went higher. Government capex in railways has started. Government is going to be spending aggressively to modernize railway. That is one sector. If government has spent, the multiplier effect is one of the highest. Boom, railway stocks have gone higher. Apple has started manufacturing in India. India has started exporting mobile phones from India. Boom, this entire design space, which includes a Sharma, which includes a Keynes, which includes a Dixon, which includes an Amber. That space has just come back. So there are a lot of these niche themes. Look at this lovely looking graph, isn't it? 42%. I think Dixon will also have a similar kind of a comeback. Tahir Basha joined just now. Tahir, good morning. Thank you for joining us. So Tahir, guessing the market is difficult. So let's talk about the businesses you like, and let's talk about what are you doing in this market. After a 10-12% hike, 10-12% jump in the Nifty, what is your strategy? What are you telling your clients and your investors?
So while we started this calendar year on a somewhat cautious note, noting higher relative valuations for India, and also the fact that we were simultaneously seeing some stress on growth, particularly coming after a very good growth in calendar year 2022 post the COVID recovery. So to that extent, I think we started off on a somewhat cautious note, and we felt that the markets would be a bit of a languid kind of a market, and then we might probably go through a combination of time and absolute correction. I think 6 months then we've seen a couple of things. One is that India on a relative scale has underperformed over the last 6 odd months compared to global markets, and that's what has helped some of our valuation premiums to actually kind of become a little more normalized. So one problem is in a way out of the way, and alongside which we've also seen actually interest rates presumably going into a bit of a pause mode as far as we can understand, and which is again a little better than our expectations, because that was supposed to come about more in the second half of the year, which basically means that P multiple decline from here essentially is arrested, and that problem at one level is out of the way. The other issue was essentially around growth, and we've seen some strains on growth in certain kinds of sectors, particularly on the consumption side. I heard you talk a lot about the manufacturing and investment cycle, and that is exactly where we had put a larger amount of our bets on. But that's worked out quite fine in the last some months, some quarters. Obviously, markets do have that tendency to do extended things in shorter periods of time, and probably valuations out there have turned a little less appealing now than what they were earlier, even though the business cycle and the momentum remains intact from a ground level standpoint. So I think we are kind of somewhat inclined to take money off the table of some of the manufacturing industrials at this stage. Meanwhile, we see some value opportunities on the other side of the table. So consumption, which has been a laggard, and probably coming out of the impact of interest rate hikes over the last 1 year or so, and also the fact that rural demand has been a little weak. So I think we are putting our monies a little over to that side. So that's the kind of rotation that we are looking towards. Technology is another sector which has borne the brunt, and pockets of value have started to emerge out there. Some of the mid caps out there have held up pretty well, so that's another pocket. Banks in general are good from an earnings compounding perspective. We know that a strong cycle is somewhat behind us, and we're looking, if we are at all thinking about interest rates going down in a year from now or so, I think it's better to look at then banks from a perspective of compounding at a steady rate rather than looking at it from the point of view of further valuation upside. So I think by and large, for some of the larger streams of the market, banking, IT, consumption, industrials, this is how we are approaching it.
Hi Tahir, this is Anisha also joining into the conversation. So talking
Hi.
about booking profits in some of the manufacturing names, still looking positively in financials and consumption. But within financial itself, what's the kind of rotation are we seeing in terms of large cap, small cap, mid cap banks, public sector versus private sector? How are you moving the stocks within the financial space?
So, the collective wisdom as of now, at least within our understanding and the team, is that we probably can prepare ourselves for a downward turn in the interest rate cycle, if not very quick, very soon, at least getting into somewhere into the middle of 24. I mean, we see relatively less reasons for interest rates to move up any further, at least after the strong hikes that we've already seen. So, that being that, then we are making our choices accordingly, because if we are trying to prepare ourselves for a somewhat more benign environment as far as interest rates is concerned, then the focus shifts towards, once again, maybe towards a little more towards private sector banks, probably trying to accommodate certain NBFCs as well, in order to, because they become obviously the larger beneficiaries in a downward trending investment interest rate cycle. So I think these are some of the obvious choices that we make, that we are making as far as BFSI is concerned. We have a mixed outlook as far as some of the non-banking, lending institutions are concerned. There are certain pockets, let's say things like capital market-oriented stories, which are still quite appealing from the point of view of value, because they've gone through a fair bit of correction, plus market indifference over the last 4 quarters, given that things have become a little more softer out there. So I think we are approaching some of those pockets with a value bias, and insurance probably once again something which is quite beaten down, obviously due to the risk that we have seen surface in the recent past. Those I think are pockets of opportunity from a value standpoint.
Tahir, hi, morning. Just taking a look at some of the recent
Hi, morning.
buys in the portfolio. It's interesting names because you've got Z Entertainment from the media space, and then within the Adani group, there's Adani Enterprises, Ambuja Cements. I just wonder what exactly your outlook is in terms of the rationale, and if you can just walk us through any recent other additions that have been made, if you're open to talk stocks.
Well, I mean, I can't talk stocks, but at least a couple of names that you called out, we don't really have a position out there, so I'm a little confused as to where that comes from. Maybe it could be in some of our hybrid strategies, if at all, but not in our frontline strategy. So at least those couple of names that you mentioned at least don't figure at this stage.
Sure thing. We'll just cross-check that, but just walk us through your outlook in terms of, what could be the potential risk down the line to the bullish thesis in the markets. Would it be primarily domestic, perhaps election-based uncertainty?
No, what we are more worried about, at least here and now, is not worried about. At least that's something which is a watchable, and partly the market has kind of reacted to that possibility. Is a weaker monsoon. I mean, that is what we are all going to be in the midst of in the next few months. So I think that's an important, watchable, monitorable, primarily from the point of view that we've seen a reasonably weak rural cycle for now, a fairly extended rural weakness for the last couple of years, and that's something which has not necessarily contributed as much to growth in the last 2 years. So I think that's important. It will become important to see how that works out. Meanwhile, the markets have taken a somewhat dim view already about businesses associated with rural demand or associated with monsoon, and have kind of been punished in the recent weeks, given certain initial indications. So I think that's an important thing that we would probably want to look at, and we hope that it doesn't turn out to be as bad as some of the prognosis which are there in the market. So I think that is one of the important risks. I think we are waiting for, we have still kind of, fairly conscious and cautious about how consumption growth unfolds. I think what's happening on the investment, manufacturing, industrial cycle is welcome, and it is much needed in the India context today. I think that will, over a period of time, drive consumption. But in the shorter run, I think consumption is not something which is a given. We have to, while we are approaching some of those parts with a value bias and a possible counter trend rally coming about. But with 250 odd basis points of interest rate hikes and incomes growing a little slower, I think it's something which is still a watchable. So we are not fully giving into and taking it very easily that consumption is a given and it'll come through no matter what. So I think that's something which we are approaching with somewhat open eyes. Credit cycle has been now very, very strong, and the credit quality cycle also has been the best possible. Obviously, that becomes a watchable going forward because you typically get accidents at times like these. So that is another area that we would watch for. Elections will come through at some point in time. I mean, later in the year, I think that is when the electoral noise levels will probably go up in the system.
Tahir, I'm also curious to know, how are you looking at this entire new age tech stocks now? They're no longer new per se. They have been there in the markets for at least a couple of years now. Paytm, Zomato, Nykaa. Are you looking at any of these names positively now?
So, we always set ourselves some 2-3 parameters to, examine and the framework through which we pass some of these companies. And one, obviously, being the competitive advantage that some of these companies would have or continue to maintain as lead over competition, etc. This is obviously a space which is reasonably prone to competition and has somewhat lower entry barriers, I would like to assume. So if there are companies in the space which have continued to maintain and shown that dominance and maintain the lead, I think that's important starting point and necessary condition that we would look to. The second is obviously we never wanted to be part of companies which are very distant in terms of profitability and very spread out in time. I think if there are a few of these which have now started to come closer to their profitability metric and profitability targets, then they clearly become a lot more interesting to as a starting point. And thirdly, I think in general, at least they're off from their very lofty valuations, which many of these enjoyed a year earlier or so. So I think the combination of these is at least making us look at some of these which have been able to score on all these 2 or 3 parameters well a little more constructively from you.
Tahir, hypothetically, if you have to invest in a non-fund Invesco, which is one fund manager you would bet on? I mean, when I speak to people, they say, Tahir Barsha is a great guy, please bet on his funds. Who is one fund manager whom you would bet on?
See, I would only say that, look, I mean, different fund managers have different styles and they have different strengths, which they all bring to the table at some point of time in the market as the market moves from one end to another. And I think, therefore, like to, I mean, if I was an asset allocator, and I probably do it at my end if I have to do my investments, I just select a pack of managers who would probably perform in different kinds of styles and different kind of environments and who are at the best in a certain particular environment. So there are value managers, and then there are ones who are very good at mid and small cap identification, and there are some who are very good at identification early growth stories. So I'd like to pick a combination of these, just to make sure that I'm covered up from most parts of the most events or most possibilities of the market's cycles.
Newspaper article, and still newspapers, Tahir, I'm like you. I mean, old habits don't die hard. World may be moving towards digital. Both you and me, I'm sure we read newspapers in the morning. The newspaper article I read a couple of days ago, which said that ChatGPT has managed to beat 75% of the funds. Disruption, right? First fund managers had to beat the index, and now they have to beat ChatGPT also. Two challenges.
Yeah, I think we'll overcome that over a period of time. I mean, we've been doing it for the industry has been doing it for the last 25 odd years, and there is a certain amount of intelligence and softer factors which sit. There are certain intangible factors which still will remain with some of the fund managers in flesh and blood compared to the ones who are through AI. So I think that should continue to remain a competitive advantage. I would like to think, and especially in a market which is pretty rich in alpha. I mean, I would like to think that India is still an alpha-rich market, and therefore, ChatGPT is one more competitor in a fraternity of many fund managers and investors. So it doesn't necessarily constrain opportunities, in my view, at least over the medium term.
But one final thought, what happens in, let's say, developed market like US, that theme normally translates into a theme or a market idea. For example, we've seen consumption, how it evolved in developed markets, it came here. We've seen how financials evolved in the developed markets, it came here. Right now, the buzzword is AI in the global market. Right now, the buzzword is that NVIDIA has become a $1 trillion company. For our viewers who are trying to connect the dots here, saying that, look, here's a $1 trillion company which has got created, whether it is artificial intelligence or giving chips to, or power the artificial intelligence software. How in India can one participate in this entire AI theme?
So I think this is still, an area of debate even within our teams. And just yesterday, to be very honest, we have been kind of trying to internally discuss as to how should we look at this whole thing. Right now, we have two options. One is to look at it from the point of view of, what kind of disruptions it can probably cause to some of our businesses, or even, let's say, what immediately comes to mind is tech services companies. And so it is more about trying to see whether there's any opportunity lost in the first instance. The other is about what to see in terms of possible opportunities. And to be honest, I mean, at this stage, we can't think of anything which is directly can be associated with AI in the Indian context. But the good part is that, I mean, if we can probably get our hands to it, there will be global opportunities. There could be global opportunities which now even domestic mutual funds can probably, tap into if need be. So there could be companies from around the world which we could probably invest in. But that's obviously something that we will have to develop our capabilities towards. So I don't know whether I'm answering your question. I don't have a direct answer, but this is again a problem that, not a problem. I mean, this is something which we are examining at our end as well.
Tahir, that's good to have you on board. Thanks so much for joining in and sharing with us your outlook on the markets. I just want to identify some of the movers, result reactions. Torrent Pharma is a buzz in trade. Remember, it came out with a profit figure this quarter versus a loss last year of about 118 crore rupees. You also did witness a margin expansion. That stock up and away. On the flip side, though, you've got something like a Liberty Shoes, which posted a loss this quarter and a margin contraction, clearly reeling under pressure in today's trading session. And something like a Lumax Auto as well came out with its earnings a little bit mixed. Net profits were down 6%. Revenues, though, scaled up to about 493 crores, with the street not taking to that quite kindly. But as promised, we're peppering the show with tidbits from that interesting and exclusive conversation with Chris Wood. Well, he says he doesn't own IT stocks in his portfolio. He's a bit unsure about the sector's evolution with the progress of artificial intelligence. But why does Zomato make the cut? Let's listen in.
No, I never have IT, but it's not really my area. But no, there's nothing wrong with the IT company. There's an interesting conceptual argument, which I don't know the answer to, which is how will the IT sector cope with AI? I've got, my base case is I'll be able to manage it, but I've got no inside track on that. Personally, right short term, I would favor staple consumers over discretionary consumers, but this is just tactical.
Have you used ChatGPT to write your free greed and fear index?
I will never use ChatGPT, but I've never used Facebook. It doesn't stop Facebook going up a lot. So so ChatGPT is kind of irritating actually, because I was hoping this was, I'm always biased in favor of Asia and emerging markets. So Asia emerging markets were set up to outperform this year if China had come back normally. But this AI story, as soon as ChatGPT happened, is created a narrative for the US tech sector which didn't exist.
The food placed on the table, guess what, has been ordered on Zomato. Yeah. And Zomato is part of your portfolio. I'm wondering why
I've just added Zomato because I've been under pressure to put that in my portfolio since the IPO, but obviously I didn't. But I think now it's in the long run, this is a very straightforward play on Indian consumption, and the total market cap is very small relative to the potential addressable market. And based on what I've been told, only 6% of the Indian population apparently currently pay for things digitally.
So, Chris, there are a couple of last follow-up questions, and I promise I'll not extend our appointment beyond that. Last 12 to 18 months, we've been in a cycle of interest rate hike globally and locally, and typically when that happens, hard assets do well. Growth stocks, they underperform. Now perhaps we could be in reverse of that. So do you think globally growth stocks could make a comeback? Guess what? I mean, you've got Nvidia, which has already become $1 trillion company.
No, but Nvidia is different, you see. So I put Nvidia in my global portfolio that when I realized this GB chat story, because in this, we
Okay, so that's the view coming in from Chris Wood of Jefferies, talking about his latest bet in the portfolio, which is Zomato. But shifting focus to the pharmaceutical space, and in terms of the healthcare earnings, we saw numbers come back for Apollo Hospitals. The stock saw a bit of a negative reaction yesterday because the numbers were weaker than expected. What's the outlook going forward? Let's decode that with Ms. Sunita Reddy. She's the MD at Apollo Hospitals, joining us on the show. Hi, thank you so much for making time and speaking with us. First up, there was a bit of a disappointment with respect to your Q4 performance, especially on margins. What's the outlook with respect to how FY24 is likely to pan out, and how was the GMV or the gross merchandise value of the 24/7 brand?
As you know, we are a company invested in the future. So we have invested into 24/7. And there you will see that we had 145 crores of EBITDA from the back end, which is the physical pharmacies. And we had a net burn of 217 crores from 24/7, which makes it a PAT negative of 89 crores. And I think this is the reason why you are looking at a muted margin. Whereas if you look at the different business verticals, healthcare services margin at 24.4%, pharmacies margin coming in at 7.5%. So very, very strong margins there in the offline business. The online business has also grown significantly. We have seen that we have crossed our target of 1,500 crores of GMV. We've moved to 1,643 crores of GMV, and we're servicing 7 lakh customers come online and offline to our pharmacies. So there is significant volume growth.
You had earlier shared your commitment goals to reduce the losses in healthcare to zero by Q4 FY24. But given the continued losses, are you confident of this guidance?
Yes, by the fourth quarter we will be a bit neutral, and I think that we're working towards that. Most of our expenditure has already been incurred, and as the revenues pick up, we will be a bit neutral.
Right. Can you just walk us through the outlook for Apollo Health and Lifestyle? What kind of numbers are you penciling in?
So if you look at this year and the performance of AHLL, I think the difference is last year was a COVID year. And this year, as we go forward, what they've really invested in is a core diagnostic business where they have 882 new centers. And therefore, there has been a cash burn on account of that. But we expect revenues to grow to 500 crores in the next 24 months coming from the diagnostic business. We also have 500 clinics. So they have created a huge network that will become a funnel into the AHL business, plus a revenue and profitable vertical by itself.
Okay, you say that you are on track to add 2,000 beds, and that will entail a capex of almost 3,000 crores in the next 4 years. Will the company look out for brownfield expansion going forward? Will it be largely greenfield? And how would you fund the same?
So we are looking at brownfield expansion. In Bangalore, we have 350 beds planned on the land that we already have. In Hyderabad, we're looking at another 150 beds on the land that we have, and we will fund it. We have let me say, cash and bank balance is about 700 crores. Plus, we'll have an additional 700 free cash flow. So I think, our balance sheet, it will not be difficult to fund expansion.
Your pharmacy division has seen an exponential growth in store addition. What we understand is that the discounts that you offer are less than your peers. And currently, what are the plans for store addition in FY24, and how could you manage, and how will you keep manage holding market share less than discounts?
Because our fulfillment ratio is very, very high. And I think it's the trust that, the Apollo brand brings to it. We have a large network. Last year, we opened 1,000 stores. And as we look into we will add another 350 stores. Having said that, the EBITDA margin coming from these stores, it has been driven by private label, where, the absolute percentage is currently at 12% of total sales, where our margin is at 20%. So we do look forward to an outstanding performance again from the offline pharmacy.
Right. And finally then, Sunita, walk us through the outlook in terms of how you're looking at the share of new hospitals increasing for FY24. Do you see an improvement in your margin profile?
So currently, if you look at, we are at a blended margin of 24.4%, and we've already touched 20% in the new hospitals with higher occupancy. Occupancy is currently trending at around 62%. We have a target of 70%. That 8% will flow down absolutely to the EBITDA, and therefore margins will significantly increase. We have increased margins by 250 basis points in healthcare services already.
Reddy, on that note, we'll let you go. Thank you so much for joining us. For the markets at this point of time, it's a bit of a recovery that we are seeing at this point of time. The Sensex is down still 230 points, and Nifty 2 is around that 18,550. But if you compare it with what's happening across the Asian markets, at least we are faring much better. It's at 18,555 is where we are at. Adani Enterprises is down about 2%. ONGC and HDFC are a couple of other counters which are seeing a maximum amount of downtick as well. But shifting focus and bringing on board my colleague Vamakshi as well to understand what's happening in the entire microfinancing space. Easy regulatory norms have given a new fillip to the demand in the microfinance industry. What are the various pulls and pushes? We get you the 360-degree analysis with Vamakshi.
Well, yes, the microfinance space is buzzing since a while now, and in fact, when you look at the returns that these companies have posted on a year-to-date basis, it's still a set there, and rightly so, because FY23 has been nothing short of a dream run for most of these counters. When we look at a Southern report that was recently released, the microfinance sector has reported a nearly 21% growth in FY23, and most listed players, as you can see, have outperformed the overall industry growth, led by Fusion posting a nearly 37% growth. The other counters with the of Credit Access, Grameen, Spandana Spooty as well as Satin Credit Care have also grown more than 20% as far as the AUM growth is concerned. The NBFC MFIs have also managed to gain market share at the cost of banks. The banks' market share has steadily declined since the onset of COVID-19, and NBFC MFIs now have the most meaningful share. The trend in fact shows that growth is actually leaning towards the NBFCs. And not just that, the asset quality for most of these counters has also seen a significant improvement, especially for Spandana Spooty, wherein the GNPA has declined on a sequential basis from 5.31% to 2.07%, and the other counters are also noting an improvement as far as asset quality is concerned. And not just that, going into FY24, the growth guidance for most of these counters also appears to be quite robust. Spandana Spooty is expecting to grow their AUM by almost 35% on a year-on-year basis, and the AUM is expected to come in at 11,500 crores, while Credit Access, Grameen and Satin Credit Care are also aiming for an AUM growth of over 25%. On the other hand, Fusion Microfinance does not see any challenge to their AUM growth. So largely a good set of numbers in FY24, improvement in asset quality and a good growth guidance going into FY24 is the reason why the sector is abuzz.
All right, thanks very much then for giving us all of those details. Let's get a move on then and focus in on the new regulatory norms for MFI demand, what the outlook is. And joining in right now to discuss that is Shalabh Saxena. He's the MD and CEO at Spandana Spurti Financial, as well as HP Singh, the Chairman and Managing Director at Saturn Credit Care. Thank you so much for taking time out. Mr. Saxena, just to begin with you then, most NBFC MFIs have posted pretty strong growth this time around. What's your outlook, and can you give us a sense as to what exactly is driving this confidence?
Good morning to you and your viewers. Yes, the numbers in general at the industry level have been very positive. One of the reasons that we can very clearly see is the improving asset quality. We've been in Spandana maintaining that this is a risk management business more than an asset management business. And hence, it's very important that if you are able to really manage the quality of the portfolio, the outcome will be the results as what you see. And overall, at an industry level, I think all the companies have done well in terms of really monitoring that key aspect. So improving asset quality is number one, is what I would want to put. Apart from that, most of the MFIs, or at least we are almost 90% rural. This is a credit hungry and a credit, the demand of credit in this segment, which is the bottom of the pyramid, and women entrepreneurs is pretty strong all through. And hence, if you look at the overall picture, the demand being strong and the quality being good, it augurs well for the industry. One last point I would want to make is the operating environment for the industry also has improved quite a bit. From a customer point of view, they realize that it's important to pay on time. This sector has seen a high resilience, and it's never the intent which is questioned. It's always the capability, which in a COVID kind of took some beating. But for the past 2 years, I think we are seeing good traction both on the demand as well as the quality side.
Good morning, Nikunj Dalmia joining in. I have a very simple question, Mr. Singh. Our understanding of the rural economy is that the rural economy is under stress. That's a channel check which two-wheeler companies are telling us, FMCG companies are telling us, auto companies are telling us. If the rural economy is under stress, where is the credit demand coming from? I mean, are these weak borrowers who are right now borrowing because they're desperate and they will have problems in paying back?
No, I don't think so. That's there. I think there are a couple of points which have to be kept in mind. One, when we talk about the rural economy in stress, we are talking about products. There is a difference between the credit demand, which is a service-oriented industry, and the product demand, which is there. When we talk about two-wheelers, when we talk about the FMCG, everybody talks about rural stress technically because it's product. Now, products are based on, the demand is based on so many other factors, not just related to the economic activity of the rural areas right now. Why we have a robust growth coming in the rural sector, which is there, is because of the sector, because of the points which Shalabh mentioned. But besides that, I think it's been that the economy has really picked up in the rural space. The income levels are getting better and better. The monsoons, which have been fairly normal, the kharif sowing and every other sowing in terms of the crops and pulses are far more better, and it's the hectareage area is increasing. The pent-up demand of the COVID, probably is also coming up. And to top it all, I think, for us to look at this, the states where we operate are practically under-penetrated in terms of microfinance activity. Now, once we say that pent-up demand, which has been there because of under-penetration, all these activities probably being there, that stress is not there for microfinance. And that's for sure. And that's the reason why everybody is talking about a 25% plus growth, in the coming years as such.
Mr. Singh, what about the ability to pay back? That's my second point. I mean, let's be clear, whether it is product or whether it is economy or whether it is COVID comeback, the income levels in rural India post-inflation have not been very high. So in hand, what you are getting after spending is actually less. In that, if the microfinance market is growing, what happens to the repayment capacity? That's my very basic question again.
So the credit bureaus actually work on over-indebtedness, and there's a lot of RBI directions as well as the household incomes which we track and look at before we actually disburse a loan. And that's a very key example for us to really look at that whether the household is under stress in terms of their paying. So the ability to pay technically arises from that. They are not over indebted to that sort. That's number one. And the second is, which is there. Rural households have not one stream of income. They have at least a bare minimum of a couple of streams of income, which is there. Revenue comes in from farming. Revenue comes from cattle, dairy farming, as well as cattle rearing. Or they would have some kind of a small scale, or a cottage or a micro entrepreneurship business activity which is going across over there. So that ability technically is not challenged at that point of time. So it's the household foyer which is taken into account, the revenue streams which are probably coming in, and that's probably one of the key reasons that ability is not under stress if you really look at this.
Mr. Saxena, wanted to bring you in the discussion and ask about how the competition is in the sector, because of course of late a lot of fintechs have come into the space. P2P lending, etc. is also increasing quite a bit. Overall, your take with respect to how the competition is in the MFI space?
Points before I come to your point, to Nikunj's point, inflation in my view, or a food inflation in our view, is good for our customer, because our customer is the start of the economic cycle. So that's point number one. Point number two is with the huge spending which the government is doing in terms of infrastructure. What has happened is that the distances are reducing and hence markets are expanding. So our customer, who's at the beginning of this whole economic cycle, has seen the markets expanding, and hence that extra added income that we've seen over the past, almost about 4-5 years. To your point in terms of fintech and competition, well, let me say that the industry is under-penetrated, as Mr. Singh mentioned. There's a huge demand. The penetration levels, the various reports around penetration levels at a conservative level are at about 55%, at a reasonably aggressive level are at about 38%. So even if we take at a 50%, that's still a headroom. The most important thing is the execution and how well you execute. The last mile delivery is what the microfinance companies cater to, and dare I say, they kind of reasonably excel in terms of running this whole shop in a very nice manner. All of this put together, fintech, to your point, it's still some distance away, because our customers, when you talk of 90% rural, are people who are still at a very primitive level. At some stage, yes, you will see some amount of competition coming in from the fintech, but we are still a few years away. This is my take on this whole thing.
Now, Salabh, let's understand the credit cycle for a microfinance company, especially in terms of NIMs. We've gone through an expansion in interest rates. Beginning of the credit cycle, normally microfinance companies will have a huge advantage because you will be taking deposits which will be repriced later on. Now that interest rates are coming down, what happens to your spreads?
So, Nikunji, we have our loans are pretty short term, from 12 months to 24 months. And our experience is that even though a customer borrows for 24 months, the average product cycle is about 13 months. So, in a way, we have a positive ALM because our borrowings are coterminous. So, so it will be about 24 months. So, from a NIMS point of view, at least our company, a range from a 13.5, 13.6 to about 13.8, 13.9 is what we expect it to hold. And both move parallel. So at some stage, if the interest rates come down, then you accordingly reprice. And if it goes up, I think, we've maxed out is our view. I think, from a NIM point of view, I would hazard a guess that we are pretty much in the sweet spot from a 13.5 to 13.8, 13.9. And it moves parallel, more so because of the short-term product cycle that we operate.
Okay, gentlemen, we'll let you go on that note. Appreciate you joining us on the show at this point of time. Just wanted to flag out Apollo Hospital. As we were discussing with the management, their earnings, the stock has seen quite a bit of improvement. It's now high by around 2%. In fact, the pharma space seems to be in fashion today. So Sun Pharma is high by almost 1.7%. Divi's Lab is also doing its bit. On the losing side, it's Reliance, which is down 1.35%, and that's putting a lot of pressure on the market. But on that note, slipping to a very short break. Don't go anywhere.
Thanks for staying on with us. Still tuned into First Trades. Now, the market regulator SEBI has issued a consultation paper seeking enhanced transparency measures for foreign portfolio investors. So, FPIs with 25,000 crore rupees equity holding in India must make additional disclosures. Let's get in more perspective on this. My colleague Ankur Mishra joins in with more. Ankur?
Yes, SEBI has released a consultation paper for FPIs, and this is regarding additional disclosure. Now, there are two major objectives of this consultation paper. One, SEBI has found that there is a misuse of FPI route in certain cases, and apart from that, the minimum public shareholding norms, which needs to be followed in letter and spirit, there has been some lapses in the same, and therefore, SEBI has come up with these additional measures consultation paper. Now, this is again a consultation paper only, not a final regulation. As far as the conditions are concerned, any FPIs which has equity holdings in more than 25,000 crore or so needs to come in the ambit of these regulations. Apart from that, if the AUM is more than 50% in certain company, again, these additional disclosures needs to be made. SEBI has also given an example how this is actually being done or misused in certain cases. It has said that, for instance, the free float of the listed companies sometimes doesn't look like that is the actual free float of the company, and there is a rerouting through FPI, and that misuse has led to not the actual identification of that free float, and hence these consultation papers have been brought in. Although there is no name or any mention of any group in the consultation paper, but market is believing due to certain instances in the past, like Adani Heidelberg, SEBI has come up with measures like this. Now, the views on these consultation paper can be given till 20th of June, and we need to wait and see how soon the final regulation is formed.
Okay, Ankur, thanks a lot for that. Ravi Jakar, Chief Strategy Officer with All Cargo Logistics, joins us now. Ravi, good morning. Thank you for joining us. I'm just looking at the headline print for All Cargo for the quarter gone, where revenues are down, EBITDA is down, profits are down, margins are down. Why is that?
Yeah, so I'm happy to share with you the performance of the company. Naturally, from a global economic standpoint, this has been a very tough operating environment, and that is what has led to some decline in performance when you compare with the previous year. Having said that, the macroeconomic environment defines how countries or economies operate, but from a business point of view, how does a company respond to such environment? And in that context, if you look at our performance, we have outperformed the market both in terms of gaining market share, in terms of volume. If you look at the international forwarding community, most of the listed companies in Europe have reported up to 17% decline in volume. As compared to that, we have seen about 7% in LCL and almost 0% in the FCL business segments. If you also look at the performance in India, which is naturally not been impacted by the economic environment, there we have seen that revenues are of course down because there's a lot of ocean freight rates, which is a pass-through cost. But despite a 20% decline in revenue from the quarter ending December to quarter ending March, gross profits have only gone down by 2%. If you compare with the previous year, the revenue drop is even sharper because the ocean freight rates have corrected much more. But the gross profit, as I said again, has been down only by 2%. So this has been the template for us, whereby we recognize that the ocean freight rates get normalized, but we are able to protect our margin, and the marginal impact on the profitability per unit is offset by the growth in volumes. So we believe that as the volumes come back in the international market, we should follow the same template to drive back to the gross margins that you were reporting earlier. In terms of the margin percentages, of course, they continue to hold well because the revenue has also gone down on account of the ocean freight. So I would say that the company's performance has been impacted globally by the operating environment, but it has been extremely resilient and driven by our focus on technology and all the other initiatives. Our market share expansion and outperformance to competitors in larger, broader markets continues.
Sure, Ravi, point taken. But could you talk to us about the outlook? You explained what went by in FY23. Are you expecting at least some sort of improvement in FY24 with respect to ocean freights, volumes, etc.?
So ocean freight rates, we believe, will remain normalized at these lower levels, and we are not factoring in any increase in that. So revenues may not see a significant expansion. But as I said, revenues have a lesser bearing on our profits because a lot of ocean freight rates are pass-through cost. From a volume point of view, if you look at, we have also started sharing our quarterly as well as monthly updates on operating parameters. So we have seen that container utilization has gone down by about 6%. The share of 40-foot containers has gone down about 12%. Now, these are the parameters driven by volumes. If you look at the April volumes, they seem to be lesser than March, but that is usually the trend. May seems to be holding back. So I would say that April to June quarter would certainly be higher volumes than Jan to March quarter, which means that it should allow us to have better operating parameters. We do not see a sharp recovery from at this point in time, but we see a sustained gradual recovery in the volumes, and we would try to top that up with expansion in our market share. So if you're able to get back to the volumes, the gap of about 8-10%, that would immediately reflect back, because all of that is a straight pass through into the bottom line, and that's what we would be intending. So I would say hope for a gradual recovery, and that should improve the performance. And also, just to bring to attention, there have been some one-off items as well, settling in for some of the prior COVID period adjustments in US, which is like write-offs beyond 1 year, etc. Those would not be repeating in the next quarter. So from a reported number point of view, there's an estimated 68 crores in the Q4, which is towards such one-off expenses which are not to be repeated. So to that extent, you would see normalized profits in the coming quarter.
So now we are talking about the numbers for the quarter gone by. That's March end. We are 2 months in this quarter. What kind of a recovery, which you say you will see a gradual recovery, will we see in this quarter? Will there be a sequential uptick or sequential drop?
There would be a sequential uptick. That's what I was reflecting, that April to June quarter would see higher volumes as compared to Jan to March quarter. That trend is clearly visible, and we would continue to share the monthly updates on the same as well.
A drastic reduction in SG&A cost, because if you have to bring margins back, it could be a function of demand, which is gradual, but SG&A expenses are with you, which you can cut immediately.
So we have already been working on it, and these have been done through a sustained digitization initiative, and which is where we have seen some improvements already in the last about 2-3 months. And over the next 8 to 12 months, you would see sustained improvements on account of there are jobs which are being automated. There are jobs which are being outsourced because they have been now defined into a certain process whereby they can be moved from some high-cost economies to low-cost economies. For an example, there could be about a good number of jobs moving from the Western economies to emerging economies, maybe 60 to 80 of those jobs over the next 8 to 9 months. In addition to that, there's a lot of technology initiatives as well. Taking one small example, a lot of quotations which come to us by email were earlier getting unresponded, which is loss of business and also unproductive manpower utilization. Today, thanks to tools like ChatGPT, we have automated those email responses. So a lot of those technology initiatives would continue to play out, and that is the way by which we would be able to, in the near term, I would say we would offset the inflationary increase in the SG&A cost by reduction in manpower through use of technology and better processes. In the long term, as the inflation rates stabilize, we should be able to control them further. And as revenue expands, the percentage margins could potentially improve on the back of that.
Now, the company also is in the process of acquiring a 30% stake from KWE. By when do you see that coming through? Can you give us a timeline, and what kind of incremental revenue and margin expansion do you see on the back of this?
So all the terms have already been agreed. The final share purchase agreement could be signed anytime in the next couple of weeks. So the way to look at the company, could be that All Cargo today owns 100% of the international supply chain business. It owns 100% because we have already bought the contract logistics partners that SPA is already signed. So now we own 100% of the contract logistics business, which is a very robust, healthy business with an EBITDA of about 121 crores, which is not consolidated again in the reported numbers because the transaction was consummated after the 31st March. So from next quarter onwards, you would see the contract logistics business also being consolidated. On the Gati side of business, as you know, the operating business sits under Gati KWE. Now All Cargo would own 30% directly with the SPA to be signed in the next couple of weeks, and 35% through the 50% shareholding in Gati. So effectively, think of it as 65% of the express business, 100% of the contract logistics business, and 100% of the international supply chain business. On the express business, we would continue to see a gradual expansion in both operating margins and top line, which has been the trend in the last 2 years as well. If you look at the FY22 EBITDA was about 50 odd crores, FY23 has been about 90 odd crores, and we believe similar trends to continue because we are gaining market share, and we are also improving the operating profit margins by way of infrastructure improvements, service improvements, and the operating leverage would also continue to play out in Gati. So on the international supply chain business, volume recovery, in the Gati business, operating efficiencies, and the now added contract logistics business, which was earlier a joint venture, would all add to the strength of the company in the quarters to come.
On that note, we let you go. Appreciate you joining us and talking to us about the outlook of the company. For now, the market continues to trade in the red, but in terms of stock-specific action, you do have Torrent Pharma that continues to soar. In fact, pharma as a whole is having a good day. Sun Pharma, Apollo Hospitals, a lot of these names are actually holding up comfortably. Also wanted to highlight one of the mid-cap names, which is Tega Industries. That's high by almost 10%. So Tega Industries is one stock which is reacting to its earnings as well. CDSL, Dixon Tech, these are some of the other names which are holding out. But one name, Nikunj, we have been continuously talking about and which has not really participated is Reliance. What's happening to that counter? Is it just the overhang of that, potential demerger, potential listing that's keeping investors at bay?
See, Reliance is an heavyweight, and typically when flows come back into a country, it is not that everything is going to be stock specific. A lot of the flows which come to a country in today's environment are dedicated emerging market funds. Those dedicated emerging market funds, they follow a benchmark, and the index, they invest in the benchmark. Now, if you put that into context, it's a bit of a surprise that why Reliance has underperformed. Then you take a bottoms up view. Say that, okay, is there anything incrementally slow with the business cycle, or are there concerns in the near term? Look, Reliance was supposed to get a huge upside because of what happened to global fuel prices, global refining margins. But that time the windfall tax scheme came in because government had to bring the inflation under control. So the big bonanza which every oil marketing company, which every oil explorer, oil refining company made, let's say in 2022, Reliance did not get the full benefit of that cycle. Now the cycle is reversing. So a lot of market men are worried that in uptick you did not make cash. In a downtick, are you likely to lose a lot more? Because government is not going to bankroll you when you are in a down cycle. The idea was to keep the inflation under check and put a windfall tax again so that exports were not allowed. So the benefits of the upcycle did not came through because Reliance was getting crude at a much lower level. That I think was the spirit. You got the other business, which is the hydrogen business, which is in an incubation stage, and the capex is still 2 years away. Third is the retail business, which is high growth, but it is growing. But if I put everything together and assume that there are two triggers for Reliance in the near term. Trigger number one is that the free share of Reliance Financial Services is going to be coming soon, I think by the end of this, second half of this year. So that for me is a trigger. Second, I genuinely feel that the war in the telecom market is over. With each passing day, Vodafone Idea is losing market share, Bharti and Reliance are gaining. And that in a sense is going to change the entire data, uptake what the Reliance stock has. So I think it's a bit of a irony that when allocations have come back to India where Reliance has underperformed, but I sincerely feel that Reliance is a long way to go.
Okay, yes, indeed. Multiple levers for growth has a long way to go, but that underperformance has been quite stark, especially at a time when we are on the verge of scaling new highs. That said, let's find out what our chartists are looking at, which are the stocks that are setting the charts on fire. Naresh is right back with us to walk us through his top recommendation. And what's your chartbuster called, Naresh?
So that's a chart for Hero MotoCorp, a dividend adjusted chart. If you look at the stock price for the last 1.5 to 2 years, the stock has gone to 2200, 2300 on the lower side and bounced back to 2800, 2850 levels. And this has been a resistance. So once it can sustain about 2850 levels, that would indicate the trend has changed finally. Over the last 10 years also, the returns have not been great. The stock continues to be giving only returns on the dividend side if you were to look at the last 10-15 years. Now, technically, this is a resistance which has been tested almost 6 times over the last 2 years. If this breaks out, that could indicate a major trend change for the stock. So out here, given that it has been knocked off 6 times, the next attempt would actually take it higher and give a breakout move. So preempting that move, an accumulate at 2700 to 2800, stop loss at 2650, and a target price of 3400.
Naresh, that's a chartbuster idea, but what about the top picks coming in? What are the stocks on your radar?
So first is a buy on Gujarat Gas. The stock has started forming up. Base has shifted higher to 460. A smaller breakout done about 500 on the triangle. Stop loss at 490 and a target price of 550. Second is a buy in RBL Bank, which saw good volumes yesterday, breakout done. Today is a say a fade off move, which gives a good entry opportunity. A stop loss at 154 and a target price of 180.
Okay, thanks very much, Naresh, for taking us through all your top recommendations. And a quick programming note for all of our viewers, because we at the Times Network are back. It's our flagship event. That's the India Economic Conclave. It will be setting the stage for driving India's economic agenda. And as we're on the path of equitable development, which is all-inclusive and universal, it strengthens not just the Indian economy, but the global one. Our theme this year is India, the emerging third superpower, where we'll feature some of the biggest voices from the world of politics, global markets, the economy, and of course, the corporate world. Catch all the action right here on the Times Network on the 1st and 2nd of June.